Hi, welcome back to Economics 360 International Trade. This is week 13 and it is our final week, so this will be obviously the final time that you will have this small talk. I had decided, as I told you last week, that probably the most fitting way of ending this course is to go through a numerical example that will show very clearly, beyond the shadow of the doubt, the interdependence of the level of domestic economic activity and that of international trade. That is to say, one must be very cognizant of the fact that the international activities place, in essence, a major constraint on the options that are available to the economic planner. Unfortunately, many of us are not aware of the major constraint that is placed by international trade, and we operate and we talk and we behave as if really it is an insignificant matter. As you'll find out in a moment, very shortly, actually it is a hugely important constraint that we really cannot afford to neglect or dismiss. But before we go into that, I would like to first make a couple of more remarks about the foreign exchange market. Remember, what we said last time is that this chapter that we're responsible for, the chapter 20, is a very simple chapter which is really only introducing the basics of foreign exchange. So for us, the thing that really matters the most is that the fundamentals of the foreign exchange market are placed on the supposition that we have a free market. Now, in the real world, we must be totally aware, those of us who live, as everyone in this class, in the United States or in a developed country, an OECD country, sometimes we tend to forget that most of the currencies of the 206 odd countries in the world are not free, and so they are not really determined every single day or every single hour, for that matter, every single moment, by a different transaction. Because the free markets of foreign exchange right now are totally practiced by the major developed countries, and they are really what is commonly referred to as hard currencies. These are the only currencies that matter for the official reserves of the central banks. So remember last time when we mentioned the potential problems that arise from a balance of payment, then a country can really make up for that by accumulating international reserves. And international reserves, for all practical purposes, are not going to be the weak currencies, the currencies that are not in demand, but they're going to be the currencies that are going to be accepted by all countries, or at least most countries, and countries and currencies that belong to major countries. So you find out that the important hard currencies are those of, obviously, the dollar, the euro, yen, sterling, Swiss franc, and what have you. So it's really essentially the currencies of the OECD countries. Now, we don't want to go ahead and digress a lot by going into history, but as I hope that probably all of us know, but just in case somebody doesn't, this is In a sense, for people my age at least, not totally recent, but it's a relatively recent development. Because currencies in the world, especially after World War II, they were set up by the Bretton Woods agreements, and according to that agreement, everything was pegged to the dollar, and the dollar was pegged to gold. So the United States had the greatest cache of gold and decided that every $35 is equal to an ounce of gold. So for every ounce of gold, you could have $35, and all currencies were pegged to dollars. So really, indirectly, all currencies were pegged to gold. So foreign exchange rates did not fluctuate that much. There was a very minor rate of fluctuation, depending on the problems that are faced in that particular economy. And so every once in a while, a country will find it important to go ahead and devalue its currency. But after 1971, Richard Nixon gave a major speech in the United States whereby he demonetized gold. And that was the end of the Bretton Woods Agreement. So ever since then, really, for the past 42, 43 odd years, we've had nothing else but what is referred to as floating exchange rate. That's to say, the exchange rates are totally determined by the forces of the market. So whenever we talk about an exchange rate, it really shouldn't be something that is very difficult to understand. It is essentially nothing else but supply and demand. So you're really talking about a price of a commodity. The commodity turns out to be, for example, French francs or US dollars or Japanese yens, expressed in terms of another currency. So really the supply and demand of that particular, for that particular currency in terms of another currency is really what determines the exchange rate. And in a free market, it keeps on changing all the time. But as you can see, international trade obviously plays a major, major role in the determination of these rates, because what is essentially the supply for dollars, the supply of dollars vis-a-vis most other currencies would be what the United States is willing to go ahead and import from the rest of the world, because we wind up paying in dollars. So we're really supplying dollars in order to buy our imports, while the demand of others for our goods is going to be the demand for dollars, that's to say, for our exports. So as you can see, this is really ultimately what it's all about. Although, I mean, there are certain other factors, but since we are not at the point whereby we're going to build a more complicated model to determine the rates of exchange, then that will really suffice. The only other thing to keep in mind is that, yeah, the foreign exchange market, there's a spot rate, that's to say the rate that you can buy on the spot in the market. There is such a thing as a forward rate, and the forward rate would be a rate that will be established between two parties through usually an intermediary, maybe a bank or an investment bank, whereby you'd be willing to settle in 90 days or 120 days or 30 days or whatever it is. And this is not to be mistaken, by the way, for the futures. The futures and the forward are not exactly the same, because the future is really a standardized contract, while the forward contract, you could make any contract that you want with another party if the other party agrees to the stipulations that you have in mind. So the forward market is slightly different than the futures market. And then there are obviously these days also the options, the calls and the puts. The call will be the right to buy in the future at a predetermined price, and the put will be the right to sell in the future at a predetermined price. Anyway, for us, we don't want to get into very many of these details, but we need one more time to stress the importance of the role that is played by the arbitrageur, as we said last time. Whenever there is an internationally traded commodity, and probably one of the best examples of an international traded commodity would be definitely currencies. But outside of currencies, to show you, I mean, exactly what is it that's meant by that, will be, let's assume, as we said last time, the price of oil, or the price of wheat, or the price of gold. All of them are really set globally at a worldwide level, and the differences are going to be very minute. Just really to cover probably the cost of transportation and what have you. But let's assume that we don't have to worry about the cost of transportation and any such small details. Then you'd really expect the price of gold, or the price of oil, or the price of wheat, or the price of dollar or yen, or whatever it is, to be the same all over the world. But what if there are certain developments in one country or in one market that are going to move the price away from the international price? Is there any mechanism that will assure us of bringing it back? And the answer is yes. The mechanism really actually is that of arbitrageurs. You have arbitrageurs all over the world that are constantly on the lookout for any discrepancy, let's say for any window of opportunity that will allow them to go ahead and undertake a riskless activity. They will buy and they will sell. They are not speculators. They are assured from the beginning that they're going to be able to make a profit. A very simple example, similar to the one that we gave last time, but let's just right now give even an example that you can relate to even more. Let's assume, since this course, some of you are on Pleasantville and others are in New York. Let's assume that the price of the textbook in Pleasantville is $100, but it's $125 in New York. Then a smart person would buy textbooks in Pleasantville and will sell them in New York. You don't take the risk because you arrange for a buy and a sell simultaneously. So immediately you will wind up in really cashing in that extra $25. But the more you do this and the more others find out that you're doing it and they step in and start doing things, what's going to happen? Then the price of books in Pleasantville is going to rise, and the price of books in New York City is going to drop until we get to that point whereby the prices in both places will be, let's assume, $112 or $110 or whatever the case might be. And this is exactly the same about arbitrage. So as you can see, arbitrage between 2 points is really rather simple. The bankers are doing it all the time. So you will have on the screen the prices of a commodity in 10 major markets in the world, and whenever you find out that there is a major difference, then you immediately bounce on it and you do an arbitrage and wind up with some profits. Obviously, the difference doesn't have to be, by the way, very large, because they're dealing with tens of millions of dollars. So the smallest difference, they'll be able to take advantage of it in order, say, for the sake of the argument, you use a $10 million trade in order to make $2,000. But all what it takes is just a couple of clicks. So it will take you only something like maybe 5 seconds in order to make $2,000. So why not? So all of these activities of the arbitrageurs make sure, therefore, that the prices are uniform all over the world. And as we gave an example last time, these things can become a little bit more complicated when you're doing a 3-point arbitrage. But in that particular case, again, you look at the cross rates and you find out that you'll be able to buy and sell in 3 different markets in order to wind up with a profit. The only other thing that I want to mention about the foreign exchange will be the role of the interest rate. And again, we explained it last time. But let me right now give you a little bit more detail, although we don't want to digress quite a lot about it, but I want to make sure that you understood it. Let's assume, for the sake of the argument, because we hear about that all the time, the so-called carry trade. What is the carry trade? Well, I am in New York. And let's assume that the interest rate in the United States is 2%. And the interest rate in the UK is 4%. So what do I do? Well, I will go ahead and I'll borrow $10 million in the United States at 2%, and I will buy spot. Let's assume that every sterling is $2, just to make it simple. So I will buy 5 million sterlings. I will invest the 5 million sterling in British treasuries that are going to be giving me 4%. So what have I done? I borrow $10 million in the United States, they'll cost me 2%. I buy British treasuries for 5 million sterling, and they're going to pay me 4%. Now, I don't want to take the risk of the getting my money back into dollars. So I will be able then to exchange them by buying forward the US dollars. Let's assume, for the sake of the argument right now, just to make a very simple example, that the spot and the forward are the same. In that case, what do I wind up in doing? I wind up in making an extra 2%. Now, if we're talking about $10 million, the 2% of that is what, $200,000. So I would wind up in making $200,000. Now, very many of the people that I know, or very many of the market watchers, are going to realize that, and so they're going to also jump in. So as more people jump in, as you can see, that window of opportunity isn't going to stay there forever. It's going to affect, therefore, both the spot rate and the forward rate. So they will adjust in order to take so that the arbitrageurs will not be able to keep on doing this until all of a sudden that interest rate premium will disappear through the adjustment of the forward rate and the spot rate. If that is where we're gonna leave it right now when it comes to exchange rates, in order to see if we can concentrate on this particular macro model. So let me repeat from right now. Actually, it might not be a bad idea. I hope that you always do it, but just in case you don't, if you will stop the video for a couple of seconds, bring a couple of blank sheets of paper and something to write with, because you might want to be able to follow the discussion over here so that you wouldn't have to keep on replaying the video if you want to understand it later on, because we're going to try and go through the details of how to resolve this problem, just in a problem similar to this one, just in case you haven't done that before. Those of you, and I understand there are a few of you that are economics majors. I don't know what is your background, but I imagine probably some of you might have taken money and banking and maybe even intermediate economics, macro, sorry. So if you've taken intermediate macro or money and banking, then this should be really relatively simple and straightforward. But in case you haven't, let me right now, for those that probably have a weaker background, that this model is a step towards realism that will show the importance of interest rate much more so than what you have met in your introductory macroeconomics. In introductory macroeconomics, you speak about production, the equilibrium, the Keynesian equilibrium using the Keynesian cross, without really making lots of references, if any, to money. You wind up really spending only 2 weeks or so towards the end of the semester talking about money creation and money supply and banking. But you don't quite really integrate it into the model. So we speak as if there is such a thing as only one equilibrium that really depends only on the operation of the economy. Now that is obviously not true, because the economy is composed, at least the domestic economy, really of two legs, so to speak, for that particular stool. And these two legs is that you have the production and you have the money market. And both of them need to be at equilibrium. So if the economy is at equilibrium, you need therefore that unique level whereby both markets are at equilibrium. The production market and the money market. Now, that assumes that the economy is not opened. It's closed. Now, if we open the economy, and in these days, as we all well know, all economies are open because of globalization and international trade and what have you, then we have to introduce a third variable. So right now, whenever we look at an economy, we need to look at three things: the production market, the money market, and the balance of payment, that is to say, the financial flows in and out of a particular country. For an economy to be at equilibrium, we need, therefore, to have these three markets simultaneously at equilibrium. That's to say, the three of them, the three functions, need to intersect at exactly the same point, right? So, what is it that we're talking about, really? Well, the production market is referred to usually as the IS market. And the IS market is essentially really nothing else but this. The Y is equal to C plus I plus G plus X minus M. As we have stated before, and as I know all of you have seen it even at the introductory level, this is the simplest description of a macroeconomy. And whether we're really dealing with a model of 10 equations or a model of 1,000,000 equations, essentially you're saying that the level of output in an economy is nothing else but the consumption function plus the investment, and to be precise, I sub G, let's say gross investment, plus the level of government spending on goods and services, plus X minus M. So G, as you will know, by the way, is not only the budget, because a big part of the budget is not spent on goods and services, because quite a lot of it is being transferred. Now, I don't want to get into these details right now. But then, all what you have to do is plug in the values of the various equations for each of these variables. So the C is also a straight line. The consumption function is A plus B Y sub D though. Y sub D, over here we want to make a distinction between output and between disposable income. Because if there is a government therefore is taxing, and so your disposable income is not exactly the same as the level of output, right? So this is going to be the marginal propensity to consume out of disposable income. Then investment is a function of interest rate, and to be a little bit more accurate in the actual problem I'm going to solve, I'm going to say that it's really a function of both the interest rate and the level of income. So it's not going to be totally fixed. Then the Y sub D that I spoke about earlier is really an identity. That's what it means, the three lines. So it's more than an equality. This is defined to be as such. So it's the Y minus the T. I know the Y from up here, therefore I need to go ahead and have a T. So my T is going to be again defined as a function. As a function of what? Of output. However, I'm going to say that the intercept is negative. So in this particular case, what did I say? I am saying that T is minus 50 plus 0.25 Y. That's to say, for every dollar change in the level of output, income, 25% of it, of the change, will be taxed. But the overall level of taxation is not 1/4 of output, because, I start with a negative 50. Let's say this is the difference between the average and the marginal, right? So this is the marginal propensity to tax, and not the average propensity to tax. If this is 0, then the margin and the average will become the same, right? And then, as you can see, I will move to the money market. So in the money market, I've got to define my my demand for money. If you've noticed over here, I said MD over P, because obviously we're concerned with the real demand for money and the real supply of money, so that is always a function of the price. But to make things easier, as you'll find out in a second, I've assumed that the price level is 1. So really then I can drop this P. So just for simplicity's sake, the demand for money is equal to a particular constant over here. It's going to increase with the level of output. The greater is the output, the greater is the demand for money. But it's going to be a negative relationship with the interest rate. The higher the interest rate, the lower is the demand for money. I mean, currently, as you know, that the interest rate is so low that probably the demand for money will be higher than what it would have been had it been the opposite, right? So what else do I need to do? I need my money supply. My money supply is going to be given in a minute, as you'll find out. Then I need a function for my imports. So what is the function for my imports in this particular case? Again, I'm saying that my imports, there is a particular constant, and then it will be a function of output. So in this case, what am I saying? I'm saying imports are 5 plus 0.02y, which means what? Again, in the same manner as we have described earlier, every dollar change on output, 2 cents of it in this particular case will be spent on imports. And again, this will be the marginal propensity to import. So delta M over delta Y, right? Then the financial flows, they're going to be again, in this case, a negative intercept plus 60R. Again, they're going to be related to the level of interest rate. The higher my interest rate, the greater is going to be the level of financial flows into my economy. Then what about the balance of payment? Well, the balance of payment is going to be nothing else but the combination of the financial flows plus the X minus M, right? Now, if you look at all of these in the general format, as you can see, what do you wind up with? We wind up with 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 equations. If you count the unknowns, though, you have 14 unknowns. So the question becomes right now, again, I hope relatively simple, but can you solve simultaneously 10 equations if you have 14 unknowns? And the answer is no. You need to have as many equations as you have unknowns in order to be able to solve it. So in this case, it really isn't a problem, because we're going to assume, and we've always assumed, as you well know, that some of these variables are exogenous. An exogenous variable is a variable that is not determined from within the system, i.e. it's given. So somebody tells us what they are. In this case, we're going to assume that G, X, P, and M sub S. Let's just say money supply, the price index, exports, and government are given. So in that case, what do we have? We have then 10 equations in 10 unknowns. And obviously we'll be able to solve them, and voila, we're going to have an answer to our problem. So if you use right now these, I'm going to say that C is 30 plus 0.8 Y sub D. So I've got to go ahead and plug this in here, and I plug the I, and I plug the G, and the X, where is my X, 24.4, and the M, I have the equation for the M. So if I add all of these equations together, I will wind up with an equation which is known as the IS. That will be my IS. The only difficulty in this, for those that haven't done this before, is this step over here. Let's just say the C is 30 plus 0.8 y sub d. I want to place this in terms of y. So what do? The y sub d is y minus t, right? So this will be C is equal to 30 plus 0.8 into y plus 50 minus 0.25y. Where did I get this from? I got this from, if you still recall, from the fact that t is minus 50 plus 0.25. But y sub d is y minus t. So it is y minus minus 50, which becomes y plus 50, and minus 0.25y. So I take this right now, I say therefore C is equal to 30 plus 0.8 of this, 0.8 of this, and 0.8 of this. I add to it this, I add the G, 150, I add the X, 240, and I subtract the M of 5 plus 0.02y. If you do this correctly, and it should be very simple, let me give you the final answer to this. This will be, once you add them all together, 0.32y. Let's say, once you wind up with an answer, it's going to be, by the way, y is equal to 340 plus 0.68y minus 400r. You put the y's on one side of the equation, you solve it, and you wind up with an IS. This IS is going to be y is equal to 1062.5 minus 1250r, which is exactly what you'd expect it to be, let's say downward sloping, right? Now, we have to do the same thing right now in order to do an LM. So the LM is going to be this. Let's say the various combinations of output and interest rate that are going to satisfy the condition of demand for money is equal to the supply for money. So the demand for money is equal to supply for money by definition. I know what is the supply for money, so I take it and plug it in. So really all what I need to do over here is say 248.75 is equal to 120 plus 0.15y minus 500r. And put the y's on one side, and voila, you have an equation for the LM. If you do this, what are you going to get? You're going to get an equilibrium right now. What is going to be the equilibrium? Where this IS is intersecting this LM. You'll find out that the Y, and I solved this already, is 1025. So the level of output is 1025. What is the precise level of interest over here? The exact level of interest is going to be 0.03, i.e. 3%. So we're going to have an economy that's producing 1025 million, billion, whatever it is, and the level of interest is going to be 3%. So what else do I need to do? Well, that's only the domestic economy. I haven't said anything right now about the balance of payment. So what do I need? I need right now my F. Now I am given the F. So the F is a negative 2.4 plus 60R. But I have just determined what? That my R is 0.03. So I multiply the 60 times the 0.03 and minus 2.4, and that will give me the level of my F. So that's going to be what, 0.03 will be 1.8 minus 2.4, it will be a negative 0.6. So what about my overall balance? It's going to be the negative 0.6 plus the x, 24.4, minus the m. What is the m? Now I have to calculate my m. I know that my y is 1025, so I plug it in here, I find out the value of the m, and I will find out in this particular case that my b is a negative 1.7. So it will be something similar to this. Let's just say this is my domestic level of equilibrium, but that results in a deficit in my balance of payment of 1.7. Okay, what do I have to do right now if I am the economic planner? I am the decision maker of this particular economy. Well, the first thing, as you might imagine, is to speak about the full employment. Now, how do I find out full employment? The level of equilibrium at full employment. The level of equilibrium at full employment, again, as well as probably many of us remember, is really a very simple calculation, so to speak. If we've done all the footwork and somebody would have done it for you in the government, then all you've got to do is plug in the level of unemployment at full employment, let's say NERU. Let's assume, for the sake of the argument, if we're going to be realistic right now, that the White House has decided that full employment is 5%. So you go ahead and plug in 5% unemployment into that macro model, and you'll get your potential GDP. Potential GDP is the level of output at full employment. So in this case, we're doing it in the reverse. We're saying, okay, somebody has plugged in that level, and somebody tells you that the full employment level of this economy is 1,050. It's not 1,025, but 1,050. So the economy needs to grow by 25, which is just over 2%. Now, the economic planner right now is not going to be satisfied, or must not be satisfied, only with an economic growth to 1,050. Because you want to find out what is going to be the level of deficit on the balance of payment. Is it going to be larger, smaller? What is it going to be? Well, ideally, what would you want? Ideally, you want a level of a balance of payment of 0. So I am, as an economic planner, I want to live in a state of bliss. I want to have full employment, and I don't want to have any deficits in my balance of payment. So what do? This is what I had spoken about, I know, half an hour ago or whatever, is that the international flows, the international trade, because the B is F plus X minus M, that is the international trade, right, is going to place a major constraint on where I should be. Because the only way I get a 0 balance is to be somewhere on this financial flows function, on this red line, which is nothing else but combinations of level of output and an interest rate. So what do I have to look for then? My level of output, I know what it should be. I want it to be 1050. But if my level of output is to be 1050, what is going to be the required interest rate? The required interest rate over here will have to fall somewhere on this F line. Now, how do I get my economy to move over here? As you can see, I'm faced with only something that is very simple. So I've got to move my IS from here to here. If I want to move my IS to the right side, what does that mean? It means I've got to follow an expansionary policy. right? So I've got to right now have the government follow, let me just assume that the only thing I'm going to depend on is government. So the government will have to increase the G. So the level of government right now will have to jump from 155 to another level so that I'll be able to shift my IS. And the shifts are always going to be parallel. So the slopes are not going to change. But this expansionary policy by itself is not enough. What else do I need? Remember, notice that this expansionary policy is going to imply higher interest rates. How am I going to get these high interest rates? Now I have to find out an appropriate monetary policy. What about the LM right now? The LM right now must follow a contractionary policy. So the fiscal right now will expand, but the monetary is going to contract. That's to say, the monetary authorities, the central bank, the Federal Reserve in the United States, will have to decrease money supply in order to raise this interest rate. And again, I can plug in all of these variables in order to find out what is it that must happen. So notice right now, I have an equation for the IS. I have right now the output, which is 1050. The equation is really very simple. So I take the 1050, I plug it in, and then I will be able to calculate what's going to be my interest rate. I would have calculated my interest rate over here to be 0.6, so I will find out how much I need to have my government increase. I will go ahead and do the same thing, more or less, for the LM. So I will find out, I know my interest rate, I know my new level of output, so I'll be able to calculate my new demand. If I knew my money demand is going to have to be equal to my money supply. And so in this particular case, since I've already done it for you, if you want to go ahead and do it so that you will be able to double check, I'm saying that my money supply will have to drop to 234.2. So 248 minus 234.2, so that will be 34, it'll be 14.2. So my money supply will have to drop by 14.2, while on the other hand, my new IS is going to show that I'm going to shift right now from 1066 to 1133, so really my government over here will have to increase by 71. So notice therefore what we're saying. So if you have an economy that is below full employment, that wants to get up to full employment, and whose foreign market, foreign sector is characterized by an X of 24.4, an M of 5 plus 0.02Y, and it wishes to have a zero balance of payment, then it will be restricted to operating at a level of output of 1050 that coincides with an interest rate of 6% in this particular case. To be precise, it's a little bit more than 6%. I think it turns out to be 6.66%. But the important thing right now for you will be the general movement. So notice the only thing is that this is a model of 14 unknowns, 10 equations, therefore 4 are exogenous. It means that you can solve it. The IS is nothing else but this. So you plug in the values for this. The LM, you are given the money supply is equal to demand, so all what you do is that you put it over here, and therefore voila, you have your LM. So once your LM and IS are solved simultaneously, that gives you the level of output. You have your F and your B, which will allow you to find out whether you're going to be at a deficit or at a surplus. Ideally, you'd like it to be zero. So if it's zero, then you'll have to adjust your level of output so that the three of them are going to intersect at the same point. And therefore, the domestic consultant, planner, economic planner, will have to take into consideration the implications of the foreign market. So definitely, you cannot operate domestically without taking into consideration what are going to be the effects of the foreign market. So with that, I will let you go, and thank you for listening for the past 13 weeks, and who knows, maybe we'll meet again. Okay, bye-bye.